Hey everyone, as I mentioned in our daily financial news, we're starting our expert series like we do every week with Greg Dickerson. How you doing, sir?
Doing great, Michael. Breaking news this morning, huh?
Yeah, breaking news. There's something that I've really come to appreciate over this weekend that I want people to hear, and I want each of my experts to talk about. And
Hmm.
that is because it's very important. If you can catch inflection points and position yourself correctly, it can lead to massive wealth. And what I mean by that is, I think it is safe to say, with a high level of certainty, that the next 12 months are going to be very different than the last 12 months, right? The last 12 months have been shutting down. They have been the Fed coming in as a massive outside force to force rates lower. They're buying gobs of mortgage backed securities. I think the next 12 months is going to be different for lots of reasons. So when I say the next 12 months is going to be different than the last 12 months, how does that hit you? How does that feel, Greg? We'll start there and then we'll talk about how you position yourself if you agree.
Yeah, maybe, maybe not. We don't know yet. So we're still not through things. We're on the fourth wave thing. Cases are rising. I mean, it's just crazy. So once we get vaccination at scale, then, we'll have a little bit better handle on things. But the more we open up, the more this thing flares back up. It's just crazy,
Mhm.
what's going on with this. And then you have the different variants and stuff. But, let's assume we get it behind us June, July, and, we're opening, we're rolling through. What's interesting is, the Fed and Treasury we've seen, and the current administration with Janet Yellen, with what she's has control of, what we've seen is the government is going to do whatever it takes to keep things pumping and to keep things moving forward. So, the next 12 months can be very interesting because, a lot of the top minds, top investors are calling for a huge sell off, in April in the stock market. And I don't know why April, as opposed to any other month, but, a lot of people are calling for a big, big cut in the stock market coming in April. A lot of it's due to Treasury yields rising. A lot of people are forecasting yields to go, really high. The question is, what's the Fed going to do? Are they going to step in, and
Mhm.
are they going to buy those treasuries to keep rates low and keep things as they've been going? But here's the big thing: if the stock market does sell off 50%, we know that the Fed is going to step in. It's going to shoot back up, so it's going to create opportunities for the speculation for everybody to keep jumping in and do all that. So, is it really going to be any different than the last 12 months in terms of what they've been doing, quantitative easing, what they've been doing, monetary policy? We've got the big infrastructure plan coming. We don't even know what that means. Is
Mhm.
that new stuff? Is it repairs? Where's the money going to go?
Yeah.
What's really in the plan? Then you've got tax is next. So they're going to
Mhm.
push spending first, and then they're going to say, oh, by the way, now we have a new
Here's the
tax
bill.
plan. Yeah. So we'll see what that says and what's entailed there. So, but what we do know is, hopefully, if we get things back under control, we can get back out there. We're already seeing an increase in travel. We
Mhm.
should see hotels start to rebound, restaurants. I went to the movies last weekend for the first time in 6 months.
Mhm.
Just because there was a good movie playing and it was open, 4 people in the theater.
Oh, wow.
That was it. Yeah,
Yeah.
still nobody going to the movies. But hopefully we'll see things opening back up. The question is, over the next 12 months, what are the opportunities going to look like? What is monetary policy going to look like? And what are, all of the speculative bubbles that we
Yeah.
are seeing stressed right now that are just going to bust any minute? Housing, stock market, Bitcoin,
Mm.
all of these things,
Well, yeah.
what's going to be the real
Yeah,
results?
let's break this down because again, I have an unfair advantage. I sprung this on you and you've had 90 seconds to think about it, and I had the entire weekend to kind of play with it. Um, so I want to break it down because I do think there's some things that we can say with pretty good certainty. And again, this is just two guys talking, right? So don't make any
Mhm.
financial moves based on two guys talking on the internet. But one is jobs. I think 12 months from now, the employment picture, both U3 and ultimately, more importantly, U6, will be lower than it is today, right? Some of that has to go with Janet Yellen. She's a labor economist, and frankly, she's so myopically focused on that. That's where it's going to be. I think it's also the infrastructure play is going to be pull people off the side. And oh, by the way, I've been talking about grand reopenings or grand openings being a big thing. So I think the job picture in 12 months is better than it is today. How does that hit you?
Yeah, it should be, as long as the unemployment premium is
Mhm.
no longer available. So that is disincentivizing people to go to work right now. I know people with restaurants, retail, construction companies that can't get people to work because they're still getting unemployment. It just doesn't make sense for them to go work.
Yeah.
Um,
I think right now
yeah,
that ends August 31st, I think. So again, inside the 12-month period. Yeah.
yeah, and they just extended rent moratoriums
I,
or eviction moratoriums, till the end of June.
I saw that.
So yeah. So, we're still not there yet. But yeah, I mean, by all accounts, jobs should start rebounding.
Mhm.
The question is, a lot of companies have realized how efficient they can be
Yeah.
without, the people. So how quickly will some of the white collar jobs come back that were consolidated and or just terminated or eliminated? We obviously know in the service industry with hotels, events, restaurants, sporting,
Mhm.
all that is where the bulk of the jobs have been lost.
Yeah.
So those should snap right back,
Yeah.
to
The
a degree.
bottom end of the K, which has been the most impacted by this, will come back the fastest for the same reason, right? It was shut down. Now it's open. Right.
Hmm.
So maybe not,
Yeah,
maybe it doesn't come back entirely, but shoot, 50% back is better than zero. So I
yeah.
think jobs is a pretty interesting thing. Then there's interest rates. That's the interesting one that you brought up that I didn't go to. So let's talk about this. I think my mind was like, okay, the 10 year is going to go up, right? The people don't realize the bond market's like $53 trillion. It dwarfs the stock market. We always talk, most people look at the stock market and think that's investing. The bond
Hmm.
market is far bigger than the stock market, right? So it's interesting to think about the bond vigilantes getting aggressive, like they did a couple weeks ago, where they took it from like, I don't know what it was, like 1.47 to 1.75, like that. I wonder
Hmm.
how fast and how high it goes before the Fed comes in, because I know you're right. I did do a video on something called Operation Twist that they've done twice, once in 1961, and then again I think it was in 2007 or 8, where they basically said rates are too high on the long end, meaning the 10 year. So they started buying those and selling the front end, kind of creating an equal book, right? They bought 100 billion, they sold 100 billion, trying to drive down long term. So if they go up too far too fast, Operation Twist will come out in a heartbeat. But if it just goes up
So,
slowly, I don't know that gets their attention.
well, you got to understand where the money's coming from that are investing in treasuries, and it's some of the most sophisticated investment funds in the world. It's pension funds, hedge funds, life insurance companies,
Mm-hmm.
sovereign wealth funds. It's people with a whole lot of money, and they've been pushed. Don't fight the Fed. Pushed into equities because
Mm-hmm.
that's the only place for yield. Now, with rates getting back over 1%, they're going back into treasury. So it doesn't take much.
Yeah,
And the question is, obviously the bond, investors are going to push yields as high as they can. The question is, how far will the Fed let it go? And I
exactly.
think the trigger is going to be this infrastructure package. I mean, this is $3 trillion that has to be paid for. So what happens is an outside investor says, look, all this money is going to have to be printed to pay for this yield in order to issue these treasury yields or treasury notes to pay for it, which is where we get the money from. That's how
Yeah,
the United States borrows money. They issue treasury notes, they sell it to pay for things. They're going to have to raise the rates to attract people, because the more we create in
mm-hmm.
terms of, what is inflation really? Well, you're inflating. Okay. So what are we inflating right now? What's our hyperinflation right now? It's currency. We
Mm-hmm.
are inflating the amount of currency, the amount of dollars that are out there by printing and issuing these treasuries. So investors are saying, well, wait a minute, I want more, because now these are becoming a risk asset. I
Yeah.
want more of a yield in order to buy them, because you guys are just going nuts with your spending.
Yeah. I think I personally, and I've said this before, and I still feel good about it. I think the 10 year gets over 2% sometime this calendar year.
Mm-hmm.
I don't know that I agree with 3%. There's a couple of calls for that. I think if it got to, I think if it jumped over 2%, right, that would be too far. And if it got there fast, again, don't bet against the Fed. Operation Twist will come out in a heartbeat, and that would be over. So let's talk about the last one I always think about on my channel, right? I talk about cost of capital, which is the 10 year for this conversation, but the other one's the consumer,
Mm-hmm.
right? We obviously have a K-shaped recovery. We've already talked about the bottom end, the service industry coming back with employment, at least back better. The thing that I'm really thinking about really goes to inflation. Is there's been record amounts of savings. We've actually changed behavior in the American consumer. We're saving about 14% versus 8% historically. We have all these trillions of dollars sitting in money markets and savings. I wonder what the consumer does. My current feeling is I read it this morning in Airbnb and VRBO, they have record bookings already for the summer. Right. So
Mhm.
I think without question what we are seeing, because the American consumer has been locked up, they've still been buying stuff,
Mhm.
things, but what we're going to see is a record return in the second half for experiences. So airlines, Airbnb, VR. I don't know that, I mean, hotels is that interesting mix, right? Does Airbnb get so swamped or so expensive that you actually end up going to hotels? I don't know what's going on, but I think we are going to see a snapback and just everybody rushing out to get these experiences that we've really held back in the last 18 months. What do you think?
Well, hotels, I think it's dependent on where you're at. So business travel is still way down. That hasn't
Yeah.
come back, but resort, vacation travel is up. So, I went down to the beach and spent, Friday, Saturday night down there visiting my daughter. A lot of times I'm on the road,
Yeah.
when we do these interviews, and, every hotel, was booked, for the weekend.
Wow.
So were the houses, all that. And this is March. So this, for the East Coast, this is an early season. So everybody that I know that has property down there now, they're all booked solid for March, when that never really is. It usually doesn't really get started good until after Memorial Day.
That's a
And then
signal.
all the hotels.
That's a
Mhm.
signal to me. The consumer is doing what I expected
Mhm.
them to do, and that is get out.
Yeah, everybody wants to get out. They want to take these, inexpensive trips and vacations. You can't travel internationally right now still, so
Yeah.
that's still not opened up. But hotels and resort areas, resort destinations. I mean, Disney's open back up again. A
Yeah.
lot of the theme parks are open back up again. Some areas are experimenting with concerts and live events and things like that. So, yeah, people are going to get out and do those types of things. But the savings is interesting. Number one, if yields go up, treasuries go up, savings rates go up. So
Mhm.
you make more money keeping your money in a money market, keep it in the bank. So that becomes more attractive. But, people now are going to keep a cushion,
Yeah.
at least for a number of years till we get through this, because now everybody knows, man, you can be shut down and shut off in an instant. You are not safe. Anybody, any
Yeah.
business could
That's a
be
good point.
shut down, and we saw just about everything get shut down. It was temporary, but what if this became more long term, more permanent? What if we couldn't solve this problem? I mean, people I think are realizing, man, I need a cushion. I don't want to get that close to not having any money at all if my paycheck stops, if my income stops. So the long term effects of this whole thing is what's going to be really interesting. How long term of a memory are people going to have once we get back and get this behind us?
Yeah. Yeah. So as I sit and look at the next 12 months, I think the consumers do what they do, and that is they're going to go buy experiences.
Mhm.
I think rates go up. The argument is how fast, how much, and then again, I think the employment picture gets better. I'm calling it the transition from dark to light. I see the next 12 months of our economy growing, not shrinking. I see Q1 better than Q4, Q2 better than Q1, and I think these things are all investable. And then I guess the last thing to talk about is the other thing I want people to really hear is if you were in something that worked the last 12 months, think, the stay at home stocks. What I really see happening in the stock market is what I call the great rotation, right? It'll be airlines and cruise lines and hotels. It'll be things that have easy compares versus companies like Clorox. I mean, I can't imagine Clorox ever matching what they did in Q1, Q2 last year, right? It's kind of the perfect storm, right? Clorox kills it and everybody, stocks up like toilet paper. They just stock up. So I think there's going to be things that worked last year that absolutely won't work this year. What do you think about that?
Yeah, you're right. There's going to be a lot of that. The interesting thing will be clothing. So will the
Yeah.
athleisure now become office leisure? What's that going to look like? The dress
Yeah.
code at the office? You're wearing sweats and pajamas
Yeah.
at the
Yeah. A
office
dress
now?
shirt and sweats on the bottom.
Yeah, exactly. So that's going to be funny. But yeah, you're right. There's a lot of those types of items, especially in sanitation, cleanliness, masks, gloves, all
Yeah.
those types of things, sanitizer. All the distilleries and stuff in our area started creating sanitizers because they couldn't sell any alcohol. Nobody was coming.
Yeah.
So yeah, it'll be a shift. But again, we'll just be back to normal and status quo. And again, the stock market's not real right now. The values are not real. Even if, Clorox all of a sudden started, producing 150% more than they did, last year, that doesn't justify the value of their stock necessarily, because it doesn't mean they're necessarily more profitable. It just means they're doing more.
Right.
So what was the cost of that?
Yeah.
You know, are they really making more money? And you're not always making more money when you have to stress and double and triple your business like that.
Yeah, exactly. When you add shifts and you add more equipment, it doesn't necessarily mean more profit. It means more units, doesn't mean more profit. So
Right.
yeah,
Because you
I
got to
do
pay extra if they're working overtime and adding extra shifts and
less
just, you know,
efficient
so.
and all of those
Mhm.
things. So yeah, very cool conversation. I do think the next 12 months are better than the last 12 months. So ask
The
yourself what
big
you've been doing.
thing,
Go ahead.
yep. And the big thing I see is the efficiencies in general. I think everybody's learned how to become more efficient, how to do more with less,
Mm,
how much certain things matter more than other things. For instance, you know, eating out, going to, you know, movies and things like that. You know, we do that all the time. I didn't really miss it over the
mm.
last year. I've really missed not eating out as much, not going to the movies. I mean, I've been busy with other things and,
Yeah.
you know, occupied. So that's going to be the interesting thing to see how behaviors are changed moving forward and how
Yeah.
companies have become more efficient, what office space is going to look like, things like that.
I totally agree with you. Thank you very much, Greg. This has been a great conversation. Number one, we've got 2 more to go, folks. Thank you.